Imagine a criminal organization earns millions of dollars through illegal activities. On paper, they're incredibly wealthy. In reality, they have a problem. They can't freely spend that money without attracting attention. Buy a luxury mansion with cash, deposit millions into a bank account overnight, or suddenly begin living like a billionaire, and one question immediately follows. Where did the money come from? That single question is what gives money laundering its purpose. Contrary to what Hollywood movies often suggest, money laundering isn't about hiding money. It's about changing its identity. Every year, financial experts estimate that trillions of dollars in illicit funds move through the global financial system, becoming almost indistinguishable from legitimate wealth. It's a process used not only by drug cartels and organized crime groups, but also by corrupt politicians, tax evaders, cybercriminals, fraudsters, human traffickers, illegal gambling networks, and scammers. And perhaps the most surprising part is that dirty money often becomes clean by passing through the same banks, businesses, and financial systems that millions of ordinary people use every day. So how does illegal money transform into something that looks completely legitimate? And why is stopping it far more difficult than simply catching criminals? The answer lies in economics, psychology, and a financial system built almost entirely on trust. At its core, money laundering exists because illegal money is incredibly difficult to use. Earning $1 million illegally doesn't automatically make someone rich if they can't explain where that money came from. Modern economies are built around documentation. Banks record deposits, employers issue salaries, businesses generate invoices, governments collect taxes, and nearly every legitimate dollar leaves behind a financial history. Illegal money doesn't have that history. It has no payroll record, no tax return, no legal invoice, and no documented business transaction to justify its existence. Until criminals can create a believable explanation for their wealth, that money remains a liability instead of an asset. In other words, the goal isn't to create money. The goal is to create a believable story. Every dollar needs a legal identity before it can safely enter the economy. Although laundering schemes can become extraordinarily complex, most of them follow the same three fundamental stages: placement, layering, and integration. The first stage, placement, is often the riskiest because this is where illegal cash first enters the legitimate financial system. Imagine someone carrying hundreds of thousands of dollars earned through illegal activity. Depositing that entire amount into a bank at once would almost certainly trigger questions from compliance officers or financial regulators. Banks monitor unusually large cash deposits. Employees receive training to identify suspicious behavior, and governments require reporting of certain transactions. Criminals understand these rules, so instead of making one obvious deposit, they often divide the money into many smaller transactions or funnel it through businesses that naturally handle large amounts of cash. Restaurants, bars, car washes, parking garages, convenience stores, casinos, and entertainment venues all receive hundreds of cash payments every day. If a restaurant reports slightly higher sales than it actually made, proving otherwise can be surprisingly difficult. Illegal cash quietly blends into legitimate business revenue, and on paper, everything appears completely normal. But getting money into the financial system is only the beginning. Once the cash has entered legitimate channels, the next challenge is making it impossible to trace. This stage is known as layering, and its entire purpose is confusion. Imagine trying to follow $1 as it moves. Through dozens of bank accounts, multiple countries, several currencies, shell companies, cryptocurrency wallets, luxury watches, artwork, precious metals, and investment accounts before eventually returning as apparently legitimate funds. Every transfer adds another layer of distance between the money and its criminal origin. The objective isn't necessarily to make investigators stop looking. It's to make tracing the money so complicated that following its path becomes incredibly expensive, time-consuming, and sometimes practically impossible. One of the most effective tools used during this stage is the shell company. On the surface, a shell company looks perfectly legitimate. It has legal registration documents, corporate directors, business bank accounts, official addresses, accountants, and often professional-looking websites. Yet many shell companies exist only on paper. They produce little or no real economic activity. Their true purpose isn't selling products or providing services. Their purpose is anonymity. Money can move between dozens of shell companies through loans, consulting fees, licensing agreements, import-export payments, or investment transactions that appear entirely legal. Each new transfer creates another paper trail that investigators must untangle, making it increasingly difficult to identify the original source of the funds. Eventually, after enough movement through financial systems, the money reaches the final stage: integration. This is where dirty money officially re-enters the economy disguised as legitimate wealth. Imagine purchasing a luxury apartment through a company, holding it for several years, and then selling it. Suddenly, the money appears to come from a profitable real estate investment rather than criminal activity. The same principle applies to businesses that report consulting income, investment profits, import-export revenues, or licensing agreements supported by contracts, invoices, and accounting records. At this stage, separating illegal wealth from legal wealth becomes extraordinarily difficult because the money has acquired what appears to be a completely legitimate financial history. The money itself hasn't changed. Only its explanation has. Real estate has long been one of the world's most attractive industries for money laundering because it allows enormous sums of money to be transferred through relatively few transactions. Purchasing a multi-million-dollar property immediately converts cash into an appreciating asset. Years later, when that property is sold, the proceeds appear to come from a perfectly legal investment. Property prices also fluctuate naturally, making exact valuations difficult. Two experts may disagree on whether a luxury home is worth $2 million or $2.3 million, creating opportunities to manipulate prices without attracting immediate suspicion. This doesn't mean every expensive property purchase is suspicious. Millions of legitimate real estate transactions occur every year. However, investigators have repeatedly identified real estate as one of the easiest ways to store, move, and legitimize wealth, particularly when ownership passes through companies, trusts, or offshore entities. Cash-intensive businesses remain another favorite laundering tool because they naturally process large numbers of transactions that are difficult to verify individually. A busy restaurant might genuinely serve hundreds of customers every day. If it quietly reports a few dozen additional customers who never existed, the illegal cash can be recorded as legitimate business income. Taxes are paid, financial statements appear accurate, accounting records match bank deposits, and everything looks perfectly ordinary. The criminal organization willingly sacrifices a portion of its illegal money through taxes because paying taxes often increases the appearance of legitimacy. Ironically, paying taxes on criminal money can become part of the laundering process itself. Technology has transformed money laundering just as dramatically as it has transformed legitimate finance. Online banking, international payment systems, digital wallets, and cryptocurrencies allow money to move across borders almost instantly. Many people assume cryptocurrencies are completely anonymous, but the reality is far more complex. Most public blockchains permanently record every transaction, allowing investigators to trace funds using sophisticated blockchain analysis tools. Nevertheless, criminals often attempt to obscure those records by moving assets through multiple wallets, cryptocurrency exchanges, cross-chain transfers, privacy-focused technologies, or services designed specifically to complicate transaction histories. Technology hasn't eliminated financial investigations. It has simply changed the methods used by both criminals and law enforcement. Today, financial intelligence agencies increasingly rely on artificial intelligence, network analysis, blockchain forensics, and international cooperation to identify suspicious financial patterns that human investigators might never notice on their own. This naturally raises an important question. If banks monitor transactions so carefully, why does money laundering continue to succeed? The answer lies in scale. Large financial institutions process millions of transactions every single day, and the overwhelming majority are completely legitimate. The challenge isn't finding transactions. It's identifying the small percentage that deserve further investigation. Professional money launderers understand this remarkably well. Instead of moving one enormous payment that immediately stands out, they often move hundreds or thousands of smaller payments through different accounts, businesses, countries, and financial institutions. Individually, each transfer appears perfectly normal. Collectively, they reveal a much larger pattern. Detecting those hidden connections has become one of the greatest challenges facing financial regulators around the world. Perhaps the most fascinating part of money laundering isn't financial at all. It's psychological. Laundering succeeds because people naturally trust appearances. A professionally designed company website, audited financial statements, corporate offices, legal contracts, accountants, and tax filings all create an impression of credibility. Psychologists refer to this tendency as the halo effect, where one positive characteristic causes people to assume everything else is trustworthy as well. Criminal organizations exploit this bias constantly. They don't merely create paperwork to satisfy regulators. They create confidence. Once enough legitimate-looking documents exist, most people stop asking difficult questions. In many cases, the paperwork becomes more convincing than the truth itself. Money laundering has also become an industry in its own right. Many professional money launderers don't commit the original crimes that generate illegal profits. Instead, they specialize in cleaning other people's money in exchange for a percentage of every transaction. Drug trafficking, ransomware attacks, corruption, online fraud, illegal gambling, counterfeit goods, and human trafficking all face the same fundamental problem. Illegal profits cannot easily be spent. Professional laundering networks solve that problem by building complex financial structures designed to transform criminal proceeds into apparently legal wealth. In effect, laundering has become a global financial service operating alongside the legitimate economy. So why can't governments simply eliminate money laundering altogether? Because every improvement in financial regulation creates new methods for avoiding it. Governments introduce stronger reporting requirements. Criminals develop more sophisticated structures. Banks improve fraud detection systems. Laundering networks adopt new technologies. International cooperation expands. Criminal organizations spread their operations across even more jurisdictions. It has become an endless race between innovation and enforcement. As long as illegal activities continue generating enormous profits, there will always be individuals willing to find new ways to disguise the money. Ultimately, money laundering isn't really about money. It's about legitimacy. Every shell company, every fake invoice, every property purchase, every international transfer, and every carefully constructed financial record serves one purpose: replacing suspicion with trust. The remarkable thing is that the entire system depends on something all modern economies rely upon every single day: trust. We trust banks to safeguard our savings. We trust businesses to report honest financial records. We trust contracts, invoices, corporate registrations, and tax documents to reflect reality. Most of the time, that trust is entirely justified. But money laundering exploits the moments when trust becomes automatic rather than earned. Understanding how this system works doesn't just reveal how criminals hide wealth. It reveals why transparency, accountability, and financial oversight remain essential to every modern economy. Because in the end, the greatest challenge isn't hiding money. It's hiding where that money came from. And once you understand that, you begin to see the financial world and the invisible systems behind it in a completely different way.